This is not the time to really focus on growing your wealth. This is the time to make sure you don't give it back. See, when you're your own bank, you set your own terms. Why would you ever want to stop making deposits into your bank? So I'm going to take that money and I'm going to recycle and recapture. Folks, if you're going to be your own bank, please do yourself a favor and don't steal from your bank. All right, welcome back, everybody. It's another week, another wealth webinar, and it's the second part of the challenge. So as all of you remember from last week, we covered the basics. We went back to just like Michael Jordan, when he hits the court, every time he learns, he practices basics, dribbling, footwork. Well, we went over the basics, the fundamentals of building your financial house. And one of the main questions we get asked all the time at the money school BYOB and the money multiplier is, how much money should I put in my policy? Well, we can't tell you that, but the numbers and the fundamentals, the foundation certainly can. So we started with budgeting. So we went through how to do a proper budget and figure out how much money you have to save. Some of you really just kind of wanted a number. So it's 10% of your gross income. That's the minimum. As per one of the challenges, it was The Richest Man in Babylon. This was the book you were to read. It's a very simple read, about 100 pages. And in here, it reiterated the 10%, right? That's the amount you should save. Now, some of you weren't at 10%. So what we did is we went through and we dissected how you could get to your goal of 10%, even if you're not able to save 10%. Another thing, too, that we talked about in there is making your money work for you. This is a foreign concept to a lot of people. It's not foreign to the wealthy, but to a lot of people that we talk to, they've only been taught how to work for money, meaning trade hours for dollars. And in my TEDx talk that I did for my daughter, which is called A Letter to My Daughter, Rethink Money, I talked to her about this in that letter on how she's going to be taught that the only way to make money is to trade hours for dollars. But that isn't the truth. A lot of people will fight you when you tell them that's not the only way to make money, because your money should always be working for you. And one thing too that I want to bring across is a lot of times when we get people on the line, they're always asking us, when can I stop making deposits into my specially designed whole life? That's a foreign thing to me, Stephen, or anybody on our team. We don't understand when people say, when can I stop making deposits in my policy? But they never say making deposits. They say, when can I stop making these payments to this specially designed whole life? Now, this is a mindset thing, and I want to hit this one right dead on, kind of like getting a swift kick right between the eyes. This is an important one. If you have a bank account, do you ever want to stop making deposits in your bank account? No, of course not. Now, when you retire, do you want to stop making deposits in your bank account? No, you want to make more deposits in your bank account. You want your income to be coming from your investments, from your real estate, or wherever you're deriving income, and then you want to make deposits in your bank. We always call that mailbox money, and people get excited about walking out to their mailbox and grabbing a check. I'll often talk about all the checks that I get, and they're usually the bill pays with the perforated corners. You rip the corners off, then you take the top piece off and fold it down, you tear the back off, and boom, you got yourself a check. Mailbox money. But mailbox money doesn't mean you stop making deposits, does it? No, you take the mailbox money and you deposit it in your bank. Everything we teach comes down to one fundamental change. Back to the basics, folks. What is that one change? Who can tell me what the one change is that we teach about how you can be your own bank? Who can tell me what that is? Where it goes first, Will said. Absolutely correct. The only change, folks, is where does that mailbox money, where does that income from your investments, where does all your money go first? That's it. So if all we're doing is just changing where your money goes first, why would you ever want to stop making deposits into your bank? Because you already said you don't want to stop making deposits in someone else's bank. So what would be the difference if you stop making payments to your bank? You should never, ever, ever ask us or ask yourself or tell yourself that you want to stop making payments, i.e. premium deposits, into your bank. See, that's the difference. You notice how I said it backwards there. I said payments, because when people make payments, That's something you want to stop. You don't want to continue making car payments. You don't want to continue making credit card payments. You don't want to continue making payments to the car insurance. So when we think about a whole life policy in the context of it, the regular way that they're set up for death benefit, that's a payment. And of course you want to stop making that. But remember, we're not using it for that. We're using it to set up your own banking system. So therefore, they're premium deposits. And therefore, you never, ever, ever should want to stop making premium deposits into your banking system. See how it's just a mindset thing? It's perception. It's kind of like the old thing. Is your glass half full or half empty? Each person's going to have a different thing. They're going to look at it. Oh, I'm actually almost empty. But another person's, going to have a different perspective. I'm half full. It's all perspective. And everything that we teach is all around those fundamentals. You're going to make deposits into your own banking system. You're going to use your money the same way the bank uses your money today. The bank doesn't take your money and put it in a vault and leave it sit. No, the bank makes your money go to work. The bank puts your money in motion, and that's what we teach. But it all starts with fundamentals. And then once you start putting your money in motion, which is the highlight of what we're going to talk about today. So in this session of Wealth Webinar, we're going to go over the second challenges. Okay, this is the second part of the challenge that we came up with. And actually, Shauna came up with it. But today, what we're going to talk about, what we're really going to focus on is the act of making your money go to work for you. Now, who can tell me if I say this one thing, what I'm referring to? The fastest way to wealth is through your own debts and expenses. Who can tell me what that means? The fastest way to wealth is through your own debts and expenses. What am I referring to there? Perfect. Nobody really knew that. So here's what we're going to do. The fastest way to wealth is through your own debts and expenses. Does anyone remember last week in the fundamentals where we talked about 401ks? And we talked about most of you having a 401k. But then we talked about how you can use your 401k to be your own bank. Yes, it's not a specially designed whole life, but we're going to use the concept. We're going to use the process to be your own bank and to make money. And what I explained is I said, if you've got 100 grand in your 401k and it's in the market, first thing I said is get your money out of the market because you want to learn how to buy low and sell high. And we are high right now, folks. We are so freaking high. And if you joined us for what the F happened this morning, I showed you how high we are. So if you're buying low and selling high, now is the time to sell. But the best way to do that and still continue to make wealth is to look on the other side. Where can your money go to work? Your debts and expenses. So most people have debts. They have car payments, which means they have car debt, which most other people have credit cards, which means you have credit card debt. And how much does that debt cost you every month? People are like, oh, it costs me $1,000 a month for my debts. Oh, it costs me 20%. See, perception depends on how you look at it. Some people think of it as a monthly expense. Other people have it down to a percentage. Doesn't matter how you look at it, whether it's $1,000 a month or 20%, that money's not going to you. That money's going to somebody else's bank. Whose bank? Visa, Amex, Discover, Southwest. I don't care what kind of credit card you have. Going to somebody else. So if you want to build wealth through your own debts and expenses, what you would look at is where your money currently resides. Is that money working for you? In a 401k, a lot of people think it is. Oh, it's in mutual funds, it's in stocks, it's in ETFs, it's working for me. Right now, it's working against you because the markets are going to slide and they're going to go down. So it's working against you. So the way to stop that bleeding is to get out. The best way to get out is through the loan provision within your 401k. Take a loan, $50,000 or 50%. So if we took $50,000 out of your 401k as a loan and we pay off $50,000 worth of debt, you were paying 20% interest on $1,000 a month. Now, what would you do next? You would take this $1,000 a month and you would recycle and recapture that money into your 401k. By doing that, you effectively made a 20% return when everybody else is losing money. How? Because you were building wealth through your debts and expenses. You were giving away 20%. Now you're recycling and recapturing 20%. It's the same thing, folks. But people, we're just as people and as what we're not taught to think that way. We're taught to make 20%. We got to go out and take risks. We got to go out and make investments. We got to get greedy. And that isn't it. There's no risk in this proposition. You're taking a loan from your 401k, which means you're getting out of the risk in your 401k because you're selling your mutual funds in order to take the loan to the tune of 50 grand. You take the loan, you pay off your debts. Your debts were costing you $1,000 a month, 20% interest. You pay the debt off. You take the $1,000 that you were paying them, you pay it back to yourself, your 401k. And then the best part about using the 401k is the interest rate that the 401k provider charges on that loan. In this example, somebody said 8%. That's on top of the 20. So you effectively made 28%. How much risk do you got to take in the stock market to make 28%? Seriously, like think about that. Too much is the right answer. And the chances are you're not going to make 28% in the stock market. You're just not on an average basis. But yet I still get clients and people all the time calling us saying, oh, those IULs, I'm going to do one of those IULs so I can have a higher return on my money than that whole life gives me. That is the stupidest thing anyone could tell me. And I don't mean to say that way, but it is stupid because you're being lied to. Your IUL illustration, the hypothetical return that they're showing you, 6 or 6.5%, it's exactly that. It's hypothetical. You're not getting 6.28% right now. You're not even getting close to that. You're at the floor right now. You're making close to zero. Oh yeah, but I can't lose money. You are losing money. You are losing money to the cost of insurance. You're losing opportunity cost. You're losing whether you want to believe it or not. And this is the problems we have. It's perception. Now, what we also talk about a lot of times is we talk about once you start becoming your own bank, I don't care if it's using a 401k, I don't care if it's using a self-directed IRA, I don't care if it's using one of the specially designed and engineered whole lives, we got to really, really think long and hard about the key thing that we're doing. Our sole goal is to keep our money in motion. We don't ever want to leave our money sitting anywhere for an extended period of time. What we actually want to do is we want to make our money go to work for us. And when people then, I already talked about the one thing where people are saying, hey, I want to know when I can stop making deposits into my policy. They call them payments. Again, we already debunked that. But you know what else people always say? I want to retire. I don't want to work anymore. If you understand money, and you understand that your purpose in this world, your purpose on this earth is to actually go out and do good things for others, to solve problems for others. If you understand that key fundamental, and you've taken the steps to do the hard work to figure out what it is that you love. And if you love something, wouldn't you do that for free? So let's just say some of you love animals and you like caring for animals and saving animals. Would you do that without pay? Oh, you already do. Great. You work for a charity on weekends. You go and you donate your time to some type of a charitable organization that helps animals, right? You don't ask for any money. You just do it out of the goodness of your heart because it's something you love. In a roundabout way, that's work. Whether you believe it or not, whether you acknowledge it or not, that is work. When you find your purpose, folks, it's not work anymore. It's your purpose. So when people say, I want to stop working, I in my mind, and folks, tell me if I'm wrong, sometimes you'll think, okay, you're going to stop working. And then what are you going to do? Oh, I'm just going to play golf every day. You know how many times I've heard that? And you know what happens? They play golf for a couple months every single day, and then they don't want to play golf anymore. And then they play a couple times a week, and then it's one time a week, and then they're bored and they're sitting on the couch the rest. And you know what the outcome is next? They die because they lost purpose. I'm not saying work in the capacity of doing what you hate, but work should be redefined. That word is almost a swear word. Find your purpose, work your purpose. And when you find your purpose, what you must do in order to fulfill your purpose is find a way to make your money work for you. Let me give you a really quick example. And I wasn't going to do this, but before I do that, let me do a roll. I just want to check something here. How many of you were with us last week in the chat? Put I. We got Jimmy with us. We got Lisa. Great. So we got a whole bunch of you that were with us. And all of you know that last week we had a challenge. Shauna put together a challenge every day. Very simple things like read The Richest Man in Babylon. And then there was some other exercises. How many of you fulfilled every one of those challenges? Put I did in the chat. They weren't hard, but every day you had one thing to do. How many of you felt good after you fulfilled on those challenges? You accomplished something and you learned something too. In The Richest Man in Babylon, in the final chapter, it hits on making work your best friend. Regardless of how you make your money, once you know how to send it off to work for you, work becomes your best friend. Pretty interesting when you actually read how that works, because if I just said work is your best friend and I said nothing else, people are like, no, it's not. I hate my job. But when you understand it, when you're fulfilling your purpose, work is your best friend. And your money loves to go to work for you, just so you all know. This money, this is just a tool, absolutely positively loves to go to work. Matter of fact, what your money, the tool, hates is just sitting around doing nothing. Because remember what I said, when your money sits around and does nothing, it's no different than when you sit on the couch doing nothing because you've lost your purpose. What do? you die. What does your money do? It dies. It really does. Ask anybody that leaves their money sitting in a bank account. Over time, guess what that bank account has? Nothing in it, because the money died. It was lost to inflation. It was lost to taxes. Stephen talks all the time about the 3 killers of wealth. Stephen, do you want to hit on those 3 killers of wealth? What are they?
Yeah, inflation, taxes, and volatility.
All of those hit lazy money, don't they, Stephen?
Absolutely, 100%.
So if your money just sits lazy in a bank account, lazy in a money market, lazy under your pillow or your mattress, as they used to do, what happens to your money?
It flees you through inflation, especially. I mean, volatility, it might be a little protected from volatility, but don't forget, volatility not only means downs, it also means ups. So you're missing out on all those ups, all those opportunities by letting the money sit idle, which is losing to inflation. And, we've been bragging about, inflation's down, inflation's falling. Inflation's still 4%. With core inflation being 5.3, which even at 4 is double what the Federal Reserve wants to do with inflation to grow our economy. So, and when you look at that coupled with what it was last year, we're at 12, 13% inflation over the 2 years. That's compounding, just like we talk about compounding money all the time. So your money is compounding, losing money each year by just sitting flat. So there's a lot that goes into that, but absolutely.
Yeah, I love that. And tonight we've got a webinar going on. And the webinar is really going to talk, it's going to be a whole another level from what we're going to cover in this webinar, but it's going to dive deep into the fundamental steps of how to make your money work for you using a platform called Private Money Club and just using resources available to all of you. So if any of you are joining us tonight, that's awesome. For any of you that didn't know we were doing that webinar tonight, now you do. We'll put the link in the chat so you all can join us tonight and learn a whole nother level of what we're about to go into. So I figured today what I wanted to really focus on is I wanted to focus on the infinite banking concepts, but specifically the terminology that we use called recycle and recapture. Because this is I think a sticking point for people, because most people can really comprehend the basics of what we explain. And most people understand the product. And that's the starting point, right? So most people understand the product. Can anyone tell me what the product is? Who can tell me what the product is? I know I wrote it on the board, but I only wrote part of it. What is the product that we use? And I talk about the product a lot. Now, the product wouldn't be infinite banking. That's the process. That's right. Especially designed. Notice how on the board I wrote whole life. Who's the one that said that? There we go. Shauna. Oh, Shauna in all caps. Specially designed. And I often say specially designed and engineered whole life insurance policy. And why do I always say specially designed or specially designed and engineered? I'm trying to help you understand it's not a normal whole life. It's not the whole life your broke ass brother-in-law tried selling you. It's not the whole life that your financial advisor talked to you about. And it's not the whole life that Dave Ramsey and Susie Orman and so many others say is the worst place to put your money. It is specially designed to do a specific purpose. And that purpose is the infinite banking concepts, okay? IBC, as we normally call it. I didn't come up with this. It's trademarked by the late R. Nelson Nash, where he took a concept that had been around for hundreds of years, used by the wealthiest families ever, and brought it to mainstream through a book called Becoming Your Own Banker. But really, most people that really aren't around the campfire, actually, how many of you are here for the first time today? Put I in the chat. How many of you are just joining us for the first time? Because we got almost 200 people on here, and I have to assume that not all of you were here last week, and some of you are for the first time. Joe and Clyde and Jalen, I think this is how you say that. Awesome. So got a couple. Karen's here for the first time. So if you're a little behind and kind of wondering what I'm talking about with some of this, it's okay. You missed the first week. This is a 2-part series, but that doesn't mean you should be like, oh, I'm just going to jump off because I don't understand what he's talking about. I'm going to bring it full circle. Promise you I am. But I also want you to understand that what we're not going to talk about today is we're not going to talk about a product. You all understand it's a specially designed and engineered whole life insurance policy that is designed to be used as a mechanism for money to go in. And what money? Well, we talked about that the first day. Roughly 10%, or the money that you save, whether or not it's 10% or not. All we're doing is changing one thing, and that's where your savings goes first. The money goes in, and then the purpose is then to move the money back out. Most people understand the product and why we use it. We use it because it's got a guaranteed interest rate, okay? And a lot of people want that right now. They want guarantees. They also do like the fact that these are mutually owned companies that pay a dividend. They like the fact of a death benefit. So someday, if they graduate too early, there's money that's paid tax-free to their significant other or their children or whoever their beneficiary is. They love the fact that it's tax-free because one of the killers of wealth is taxes. And they love the fact that it's got uninterrupted compound interest. I'm just abbreviating things, which all these are great, but they're not the reason we do this. The reason we do this lies over on the right side of the circle over here. And this is what I like to call the opportunity zone. And the opportunity zone is really infinite in its capacity because opportunities come in lots of shapes and sizes. For some of you, opportunities are business ventures. For some of you, opportunities are your side business or your main business. For some of you, opportunities are giving. Some of you, opportunities are buying a new car. Some of you, opportunities are paying off debt. See what I'm saying? It just goes long and far. Now, we already did the debt thing with the 401k last week. So what I thought I would do is walk you through a real example of how this can work. Now, I don't want any of you to judge, okay? But this is real. And this just happened yesterday. And it happened, and I'll explain the story. So this is completely off the cuff. I have not done this yet, but I have to do this. So I figured, what the hell? In the Wealth webinar, why don't I teach people how recycle and recapture works by using the infinite banking concepts in a real world scenario where I'm doing it with you for the very first time. Does that sound fun to any of you? And we're going to make it around a thing that all of you can understand, and it is a car. But it's not a car for me. It's a car for my wife. So it's even better because, you know, listen, this is for my wife that we're going to be doing this. So first and foremost, let me kind of frame it up. So my wife's been driving the same vehicle for several years. It's a great vehicle, but it's at that point now where, just like any used vehicles, we don't buy new vehicles. All used vehicles have a point of diminishing return where it really starts to go fast. It's usually about 60,000 miles. So when a vehicle gets 60,000 miles on it, the value drops significantly, okay, and continues to drop because from 60 to 100,000, it's actually 50,000 miles, but the car goes from a retail car on a dealer's lot. They can sell it at retail for under, anything under 60,000. But if it gets over 60,000 miles, and some of you maybe are in the car business, so you can kind of give me some extra pointers here. But if it's got more than 60,000 miles, it's a wholesale car, meaning they just ship it off to the wholesale and they just get what they can, which is why your trade-in on your vehicle when it's got over 60,000 miles is usually like, whoa, I thought it was worth more than that. Anyone ever have to deal with that? Whoa, I thought it was worth more than that. So her car's almost at the 60,000 mark. We've had a lot of things go wrong with it recently, but luckily it was under warranty. And now the warranty ends in November and the new warranty is $5,000. So I got a lot of uphill headwinds to look at with this vehicle. So my wife loves driving my truck when I go out of town. And there's never a weekend when I'm out of town or a week when I'm out of town for work that I come back and my seat isn't, I get in my truck and it's like my knees are in my jaw because my wife's shorter than I. She loves driving my truck. So we've been searching for vehicles. Now, when I buy a vehicle, I might do it the same way as some of you and different than some of you. I will spend months looking for a vehicle, but I don't just look. I find one, I call the dealer or the seller, and I make them a lowball offer, an embarrassing offer. And usually they dismiss the call really fast, especially dealerships. And they got a car listed for 90-some thousand dollars. They make them a lowball offer. They say, oh, there's no way we could do that. But you see, I do know something. I know that if that car sits on their lot longer than 30 days, they will do something because that car then gets shipped off the lot to the wholesale lot where they're going to bring significantly less, sometimes even lose money. And hey, listen, I kind of want the dealership to lose money so that I can get a good deal. Right? Everybody understands that. That makes sense. The dealership loves when people walk into the dealership and they don't ask any questions. They just say, how much is the vehicle? And they say, okay, great, I'll take it. And dealerships have gotten really good at selling vehicles on monthly payments, which is why leasing is such a popular thing. I don't buy cars that way. I make stupid offers on cars. I piss people off, but I'm always upfront with the dealership. And I always tell them, listen, before I waste any of your time, I'm just letting you know I'm not paying full price for the car. I'm going to make you an offer. I know you probably won't accept it, but if the car sits on the lot, I want to be the first call. That's what happened here. This is a vehicle that we identified. The color is the reason the vehicle didn't sell, but it's the exact vehicle my wife wanted. At first, when she looked at it, she didn't like the color, and then she grew fond of the color. So what I thought I would do is just show you guys the vehicle. Here it is. Some of you will like it. Some of you will hate it. So it's a 2016 Mercedes-Benz G63 AMG. This kind of funky looking, red looking color. I don't know. You know, do some of you like it? Do some of you hate it? A lot of people just hate G-Wagons. But the thing about a G-Wagon that you cannot hate on is these stupid, ugly, heavy gas guzzlers hold their value. And I'm sorry, when I'm buying a vehicle, I don't care what I got to pay for the vehicle. I care what it's going to lose. I have studied these stupid trucks. They hold their value better than any other vehicle I've ever seen. So up here is the price that they were asking, which has recently been reduced, $92,999. It's a lot. I went to him and I offered 85 months ago. Well, no, not months ago, probably about a month ago. And the guy even told me, he says, I'm going out of town. And, you know, if it doesn't sell, I'll call you when I get back. Kind of a brush off. So I offered him 85. He didn't call me back, but I called him back. And I said, hey, Joe, I see that car hasn't sold. Now, what I know is we just turned a new month. And I know that this vehicle's probably been sitting on this lot for about 30 days. And I said, Joe, I know why the vehicle hasn't sold. It's a color that people don't want. When people are buying G-Wagons, they want white, they want black, and that's about it. Maybe gray is acceptable, but they don't want this salsa, whatever they call this thing. But my wife likes it. So, Joe, we're a cash buyer, and we'd like you to consider the offer. Will you take this to the boss and ask him again? And he did that. How much do you think I ended up settling on this vehicle? Does anyone want to guess?
85.
Oh God, I wish. Colleen nailed it. 87,000 bucks. I offered 85. So Shauna said 80. I mean, I offered 85 initially. So I got it for 87 grand. But that's not the important thing, okay? The important part is how I'm going to buy this vehicle. And that's what I'd like to walk through with all of you. Now, whether or not you're buying a G-Wagon or any kind of car, it's the same process. And that's what I thought I'd like for all of you to understand. But in me teaching you how I'm going to buy my wife's vehicle, I want you to understand one thing. It doesn't matter if I paid 87 or 80 or 100 for this vehicle, because I get all the money back for it no matter what. Okay. And most of you understand it, but let's walk through the process on how this works. So first off, we're going to buy a vehicle for $87,000. Now, my wife already has a vehicle. Okay. And I think they offered us $43,000 for her vehicle. And I said, no, because I think I can sell it for 51. I'm pretty confident I can sell it for 51. So I did the math to figure out what my tax savings would be. If I traded in, I get to reduce the purchase price of that vehicle by 43 grand, which means I save, it works out to be about $3,700 in sales tax. But if I sell the vehicle for 51, I ended up doubling the amount. So I make about 7,000 extra. So it outweighs the tax advantage. Fair enough? So everything for me is a mathematical equation, because a lot of people are like, why wouldn't you trade it in? Because then you don't have to pay the taxes. This is how the dealership gets you all the time. Oh, but if you trade your vehicle in, we save you on the taxes. But how often do they actually run the math for you? Probably very little. But in your mind, you're like, oh, honey, see, if we trade the vehicle in, number one, it's less work. Number two, you don't have to deal with anything. You just hand them the keys. And number three, we save on the sales tax. But I ran the math. And it was half of what on a low side, half of what I'd make just by selling her vehicle outright. So the first thing I got to do is I got to go in and I got to figure out, what would this vehicle cost if I finance it? So that's the first step we're going to do. So let me walk you through how I would do this. All right. So auto loan calculator, nerd. All right. I like bank rate. So we already know that the vehicle's 87,000 bucks. Okay. So 87,000, 60 months, interest rates. I don't know what interest rates on cars are right now, but let's just say about 7%. Okay. We'll put 7%. And I could, if I could go in and find a rate, but you can see down here, there to give you the rates. So we got auto pay at 4.6. Okay, whatever that one is. So all these, but let's just do 7%. Now, if I do that and I put it in, my monthly payment on an $87,000 vehicle would be $1,563. So real quick, on the board, I'm going to write $1,563 a month. Nobody has any questions on how I just figured out what the monthly payment would be, right? Now, because I'm buying this vehicle with my own bank, okay, this rate can be anything I want. I'm in control of the rate. So if I didn't like a payment of $1,563, well, I could drop it down to 6% because I'm the bank, $1,682. But you see, that's not really that big of a difference, is it? I went from, wait, what the hell did I just do? Oh yeah.
I went backwards.
I went backwards. Hang on a second. I don't think I clicked it. There we go. 1723. Sorry about that, folks. I guess you got to hit an extra button. 1723 would have been the monthly payment at 7%.
Car's getting pricey, Chris.
I know. Shit. But see how that, some of you are like, oh my God, who in their stupid right mind would ever pay that much money for a car? And that is the old way of thinking. See, when you become your own bank, I don't even look at this amount. You know what I'm looking at? I'm looking at this amount. And let's do this the way that you're thinking. If I pay 6% interest for 60 months to buy an $87,000 car, that's $1,682. And if I paid that to someone else's bank, that means they would have charged me $13,917 in interest. When I see that, I salivate. I get really excited looking at $13,917. You know why? Because who's getting that $13,917? I am. My bank is, not their bank. My bank is not Lightstream, AutoPay, Caribu, or whatever it is. I haven't even heard of any of those. So this is my bank. So actually, let's just use the 6% here because I want to save myself a little bit of money, right? But I'm not saving myself any money. I'm actually hurting myself with going with a lower interest rate. But let's just say I'm going to use this just for simple math, $1,682 a month. That's going to be my monthly payment. So now at this point, we're completely done with that page. Now we're going to come back over here to the board, and I want you to understand. So that's how much money the vehicle costs. This is how much the monthly payment's going to be, which is usually how people buy vehicles. But now the next step I'm going to do is I'm going to take a loan from my policy. So I'm going to do this a little different. The way I'm buying this vehicle is going to be kind of unique because number one, I'm going to take it's going to be about, I haven't gotten the final number, but let's just say it's probably be about $96,000 after taxes and shipping. So I'm going to take $96,000 out from my policy, which is a loan. Now my policies are all connected to a cash value line of credit. Okay, it's a line of credit through a bank that I use, and my interest rate is 5.75%. So what I want to do here, this is very important, so pay attention. We're talking about recycle, recapture, but there are 3 different interest rates that we need to talk about. And a lot of people get very confused with the different interest rates. Like they're like, well, who gets this interest rate and who gets that interest rate? And they get confused. So what I thought I would do today is do a much better job of explaining the 3 different interest rates we need to talk about. The first interest rate that we talked about today was the guaranteed interest rate that the insurance company pays you or puts into your policy, correct? We all know about that. And how much is the guaranteed interest rate? Well, it depends on your policy, but anywhere between 2 and 3.25%. Okay. The policies that I have are probably a blended, because I have some 4%ers. So let's just say mine are 3% for simple math. Okay. They're probably a little bit more. That's interest rate number 1. Now, who can tell me what interest rate number 1 is? So it's interest, but what's the most important part about the interest that the insurance company pays me? Who can put that over in the chat? That's right, Mike. It's compound interest. So every year I get paid this 3% interest compounding. Number 2 interest rate that I really want to hit on, and this is one that a lot of people confuse, so I think it's important, is the loan interest rate that the insurance company charges me on this $96,000 loan that I'm taking out for my wife's car. Who can tell me what kind of interest that is that we just looked at on that calculator? That's right. Joe said simple. So number 1 thing we need to understand is there's different types of interest. One is compound interest, which is, as Albert Einstein says, the 8th wonder of the world, the most powerful thing in the universe. Those that understand it, earn it. I'm earning it. Those that don't, pay it. People that take out car loans to buy cars, pay it. Simple interest. Simple interest is easy. You just take the amount, 96,000 times 5.75. The interest is the same every year. Compound interest, my interest is the same from a rate standpoint, but next year I make more money. Why? Because the interest is now compounding on top of interest. So I'm making money on money. My money's working for me for the rest of my life. The other thing too, a lot of people don't quite get here, and this is important. If I started with, and I'll ask the audience, I'm going to just use a different color here. If I started with $100,000 here in my policy, earning 3% compound interest plus dividends, which puts me at about let's just do 5.6% is about what I'm making. A lot of people would look at that and say, wait, you're making 5.6%, you're paying 5.75. Most people, when they see that, would think I'm losing money. You're only making 5.6% with dividends, but the insurance company, those greedy bastards, are charging you 5.75. You're losing money, man. Stop. Compound versus simple interest. Google it. Watch our 90-minute video. We got the example of the really good bank, and then the person earning 4% in the really good bank, but yet paying 6% in the loan. And remember, at the end of the loan, you end up making $1,526. Why? Compound versus simple. So I'm just trying to set that up. But the other thing here that's really important to understand is not the math, but I am hitting the math while I'm doing this because I'm trying to hit the objections we hear every single day. People are like, oh, I'm only making 5.6, but the insurance company charges me more than 5.6, which right now, that isn't the case. All the companies we deal with, the interest you're earning with dividends is more than what the loan interest rate is. And it's getting better by the month. If I put 100 grand in and I take 96,000 out as a loan, how much money's left in my policy earning 5.6%? Who can tell me? 100,000, Mike said. Was anyone doing the math and thinking 4,000 was left? Honest question. Did anyone think when I asked that there was only 4,000 left in my policy? So all of you have understood that when we take money from our whole life, we're actually not taking our money. We're actually taking 96,000 from our death benefit. The insurance company is loaning us our death benefit. So really this 96,000 is 96,000 being taken from my death benefit. But it doesn't mean that my 100,000 isn't affected. My 100,000 serves as collateral. So if I do this transaction, I only have 4,000 left that I can take out, but I have 100,000 in there earning interest and dividends compounding. Okay, so back to what we're doing. I buy the vehicle. I already did the calculation. Now what I'm going to do is I'm going to do a note, as I always do. I'm going to do a note, and me and Tess have been talking. Tess is, hopefully going to help me get all of my personal stuff in order, but I always have notes for every loan that I do. So I take a loan from my policy for 96,000. I buy Larissa's vehicle, and I'm going to do a note for the amount at 6%. So we all know is 1682. And this note is just a promissory note. Why do I have that? So that I don't forget. That's all. It's just a simple piece of paper. And I do sign them because I feel my signature on something binds me to it. And I don't care if it's my bank funding my car, it's still a transaction. And my bank is separate from me and my personal item. Okay. So that's how I do things. What I'm now going to do is the single most important thing for this training. I am going to recycle and recapture. Because a lot of people, this is where they stop, right here. They understand the product and they like the product. They want to earn uninterrupted compound interest. They want the death benefit, the tax-free nature. They want uninterrupted compound interest. They want guaranteed interest rates. And they want to take a loan. So they do. They take a loan and maybe they go buy a vehicle. Okay, in this scenario, we bought a vehicle. But a lot of people stop there because they think in their mind that this was their money to begin with. And all they did is took their own money to buy the vehicle. Why would I ever pay myself back? Folks, if you're going to be your own bank, please do yourself a favor and don't steal from your bank. Because like I mentioned earlier, if you steal from your bank will end too. It'll die. Your bank will go bankrupt eventually. Maybe not right away because you're earning uninterrupted compound interest, but eventually it won't be good. You would never steal from Ally Bank. You would never steal from Bank of America. You'd never steal from Wells Fargo. They'd lock you up. So why would you ever steal from the bank of you? You shouldn't. And therefore, I'm not going to. $1,682. What I'm going to do is I am going to set up a bill pay. Okay. Whatever account, that I get my income in, I'm going to set up a bill pay for $1,682. So I'm going to take that money and I'm going to recycle and recapture $1,682 a month back to my policy. And how am I going to do that? Well, I have a separate bank account down here, okay, which is called my segregated bank account. I actually call it my operating account. That's what I call it. $1,682 a month will go into this account. The only thing that this account is used for is my banking. That is it. It's literally books and records. If I ever wonder if I missed a payment to my bank, or I ever wonder if somebody didn't make a monthly payment to me on one of the loans that I do, I just go into the bank statement and I look because it's books and records. So once that bill pay lands in this account, what I'm going to do is I'm going to go to the insurance company. I'm going to fill out it's pretty much a one-page form, but you guys don't need to do this. Our team will do it if we're working with you and setting this up. We're going to set up a loan repayment form. Now, I know my teachings differ from Brent Kessler's, but there's not a right or wrong way to do this. So I want you to pay attention closely because I take the whole circle and I close the gap. And I'll show you why. I take this $1,682 and I set up a $1,682 a month repayment back to the policy. And what's happening every month, $1,682 is being swept automatically. This is all auto. It's automatically recycled and recaptured from my segregated bank account, my operating account, into my policy. I don't need to think about it. Only thing I really need to make sure is that this bill pay is set up and it's getting deposited. And it doesn't even need to be a bill pay. It can be a transfer if it's the same bank. Okay, so it doesn't matter how you do that. Just make sure the money makes it here. And then if the money makes it here on the 5th of the month, sweep it on the 15th. Give it some time to clear. And then it automatically sweeps back up to the policy. So I've completed the circle. I started changing where my money went first. I put it into a specially designed whole life, the product. I then made that money go to work. And this is the real example. I bought a vehicle for my wife. I figured out the monthly payment. I then set up a bill pay or a transfer to my segregated account for the exact amount that I told myself I would pay. And then I do, or the mapping team does, a bill or a loan repayment for the same dollar amount, $1,682, back up to the policy. But for right here, this is where I differ from Brent. He doesn't take this step. He calls it playing financial gymnastics with the insurance companies, which I agree with. But you see, since I do everything mathematically, like why don't I trade the vehicle in versus sell the vehicle outright? I'll save the taxes if I trade it in, but if I sell it outright, it's more work, it's more energy, but I make more money. But how much more? I mathematically solved that. Here, I've mathematically solved this. Me and Craig Yenny on our team has mathematically solved this. Who can tell me why I would want to do this? Why would I want to take the $1,682 from the segregated account? And that's right, reduces interest. Think about this. $96,000 loan is being charged 5.75%. My loan that I pay back to my bank is at 6%. So right there, that is a 25 basis point spread. But not only that, I'm making 25 basis points from this payment to what I'm actually paying here, but I'm also now paying down the loan, which means since this is simple interest, as I pay the loan down, what happens to the interest charged on the loan? It goes down, right? So every month, this $96,000 loan against my policy that's charged 5.75 is less. Therefore, I get charged less in interest. Some people would say it's pennies or nickels, but listen, I just say I'm a professional penny and nickel picker-upper. That's just what I call myself. I don't care if it's a penny, a nickel, a dime. I'm picking it up because this just makes sense to me and it's no extra work for me. And also the cool part is every month, $1,682 more is available to me to use. And the bank doesn't get to hang on to any of my money, which is another win. So remember, we talked about the 3 different interest rates, right? We talked about the first interest rate was this one over here, the guaranteed interest rate, compound interest. The second interest rate, simple interest that is charged on the loan. This interest goes directly to the insurance company. In my case, it goes to a bank, but just think that this goes to the insurance company. So this first one goes to me. This one goes to the insurance company. The third interest rate that we're referring to here is the one that I decided to charge myself, 6% simple interest. Who does that 6% go to? Me. So I win twice. I make a spread between what they charge me and what I charge myself. My bank charges me, but I also never stopped earning interest and dividends over here uninterrupted. This is how I do everything. This is how I buy copy machines for the business. This is how I'm right now funding some of Private Money Club's marketing. Okay, I'm taking loans and I'm paying for marketing. Okay, this is how I opened Private Money Club. This is how Doris Christopher opened Pampered Chef. She took a loan from her whole life, started her business called Pampered Chef, just a little cooking company. Then later, well, you all know, she sold it to Warren Buffett for billions. I can't remember the number, but billions of dollars. Does everybody understand what happened there? This isn't complicated, but it is a mindset shift from what you're used to because we covered each one of those steps. We covered the mindset. This is going to be part of your challenge the next couple days. You see, after today's training, after this wealth webinar, there's going to be challenges every day up until Tuesday. And I hope a bunch of you take us up on the challenges because this is how you further and this is how you learn and this is how you change your mindset. I think sometimes we put too much emphasis on learning and not enough emphasis on application. We all want to learn, but then we don't apply, which means the learning is useless. And not only that, these challenges force you to learn and apply what you've just saw. Saw how I'm going to buy a vehicle. Now, some of you can apply this right now because some of you haven't started the policy. But by doing the challenge, it will force you to apply the knowledge in a different way. And actually, some of you will actually take the exercises above and beyond the challenges, and you'll go out and you'll say, how could we do this with our vehicle? And you'll start penciling out all the math and you'll put it on a piece of paper. And maybe some of you will actually take that piece of paper and the photo of the vehicle you're going to buy, and you'll put it right on a mirror on a wall and you'll stare at it every day. It's called vision board. However you decide to apply what you learned today is equally as important as learning it. Actually, I would say far more important than learning it. You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, It's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up. But Stephen and Shauna, let's just stop here for a second. Let's just hit some of the questions we have on this first part of today's training with Recycle and Recapture.
So Mabel was asking, how about using a HELOC to own a whole life policy? They're not able to calculate the math. So kind of going back to.
You would never have the HELOC would never own the policy. You personally or a trust or a business would own the policy. So the HELOC could be used to fund the policy. I typically don't do that. And I'm in full transparency. I know, Joseph on our team is a wizard at this, but you have to really learn how he does it with an all-in-one mortgage. I don't do this. I have lots of equity in my house, but I don't use that equity to put that money into a policy just because it's another variable that I can't control. So the interest on the HELOC has a variable interest rate and can go up and can go down. If it goes down, it's good. If it goes up, it's not so good. So how I do it, and I'm not saying it's wrong, okay, but just realize when you add a HELOC and you take a loan from your HELOC and you put the money into the policy, it's just another thing you got to consider, another variable you have to consider. I'm not saying it's bad. Matter of fact, it's quite the opposite of bad. It just requires you to pay attention to it. So how I do that, I take money from the HELOC. Whoops, let me change the color so you guys can see it. I take money from the HELOC, and all I do is I just lend that money out direct from the HELOC. So I would take the money from the HELOC. I might lend that out to, one of the people on PMC. I might make 12%. So my HELOC is 8% right now, and I can make 12% over here in Private Money Club or more. Actually, the current deal I'm doing is 13%. So what's the spread between 8 and 13? That's what I make. Okay, so I make the spread in between. So then what I do is I pay the 8% back. So out of the 13, I pay the 8% back, the 8% from the deal. But then I take the difference, the spread, and I put that into a policy. That's how I do it, which is maybe a little different. I'm not saying you couldn't go direct from the HELOC to the policy to Private Money Club. Perfectly fine. There's just multiple ways to do it.
It's kind of like velocity banking and how some people just don't want to they don't want to get into using credit card, whatever it is, however you do velocity banking.
I just hate banks. So by doing this, I'm always tied to the bank. Like until I pay the HELOC off, I'm tied to the bank. Here, independently, I just feel it. I don't know. It's a personal thing. It really is. And each of you are going to develop your own personal little pet peeves for this, kind of like Brent's personal pet peeve is he doesn't take the money from the segregated account and put it back into the policy. He calls it financial gymnastics. He takes it from the segregated account and moves it back out, and that's how he does it. Nothing wrong with that. Works perfectly fine. Mine, I just pick up nickels and pennies along the way. That's all. I was taught to do that. When you focus on money, you find nickels and pennies on the ground. When you don't focus on money, you never see the nickels and pennies. Jonna, Steven, anybody on my team will know we could be walking anywhere in a crowded place. If there's a penny on the ground, guess who's picking it up? This guy. Not because I need the penny, it's just principle. It's just what I've trained myself to do.
All right. If I use the policy to save to pay property taxes, explain the difference between paying the taxes using a policy loan versus withdrawal of the cash value. As I understand, if the interest and dividend are 6% and the loan rate is 5%, I make the spread, that makes sense. But what are the consequences of using the cash value instead? One con is the money won't be compounding while I'm building up the funds. Any other cons?
Edgardo, I've got a great video. It's a case study we actually did with a client of ours, Gary Proctor, and it's exactly that. Your question is exactly what that case study is. So I don't mean to push you off, but to your challenge list, watch that video and it explains. There's two ways to do it, but one way you would never want to do it is take withdrawals from the policy. You'd be better off just keeping it in a bank account and paying the taxes. But if you're in real estate and you're going to have property taxes or any kind of taxes, just know you're always going to have taxes. They're never going to go away. So you create yourself by using the policy, a continuous never-ending flow of money that gets to go in and out, because every year you're taking some of the rent, you're saving it for taxes, and then you're just recycling and recapturing that money automatically. You can do that from a bank account, but by doing it with the policy, you mentioned it right in there, you continually make the spread. But just watch that YouTube video and that will fully explain the mathematics behind it and why Gary chose to do that versus doing it, the other way, which is just keep it in a bank account.
And just to, if you were to withdraw money from your insurance policy, it would be taxable. The money's now gone. So that's not, something that you would want to do.
Yeah, you'd lose the uninterrupted compounding of that withdrawal from the policy.
All right. Does a dump in affect the monthly deposit?
Yes. David, it does. It's a bit complex. It really plays into the MEC rules. So the easiest way to understand that is if you dump in money, and there's different, not all insurance companies are different, but here's the simplest way to do it. You want to dump in $100,000 into your policy. Does that affect your premiums? Yes. Typically, we can do 10 to 12 times that into the premium. So what we would always say is your minimum that you're going to be able to put in is about 12,000. Now, if you're a little older, this could be actually 15,000. So again, it's not a rule that the insurance company or us makes. It really comes down to the MEC rules. But typically, for every, you can do it 10,000 too, but every 10 grand or 100 grand you put in, you're going to do 12 to 15,000 is going to be your bare minimum. You can do more, but that's going to be your bare minimum to make that work within MEC rules.
Just clarify, do they need a CV, cash value line of credit if they live in New York also? Or can you elaborate on that a little more, please?
No, Michelle, great question. You do not. You'll, unless you have Mass Mutual, which we don't write anymore, you typically don't need a cash value line of credit. So a lot of people would be like, well, why would you use it? The simple answer is I have 9 policies, and actually it'll be 10 soon. So I'm not going to draw them all here, but I want you to think about that transaction that I went over a second ago with buying the vehicle. If I don't have 90, or $87,000 in any one of these policies, what that means is now I'm going to this policy doing a loan, this policy doing a loan, this policy doing a loan, this policy doing a loan. I've got maybe 4 companies that I'm taking one loan out to accomplish the goal. Okay, so by doing that, that's more work. Plus, when I'm repaying the policies, hence why Brent also doesn't do it. When I'm repaying the policies, I got to do a loan repayment with this company, a loan repayment with this company, a loan repayment with this policy, and a loan repayment with this policy. By doing the CV line of credit, what it allows me to do is household all 9, 10, 11, 20 of my policies. So all policies, as long as they're our same ownership, can be householded into one common place, which is my line of credit. And then when I buy a vehicle, I got one checkbook that all I do is I just write a check out of this one checkbook and I pay for that vehicle. It's just simpler. Does it cost me a little bit more? Yeah. I pay 5.75%. And the bank, the CV line of credit, charges me interest every month. So every month I got to make payments back to the CV line of credit, where with the policy, it's once a year. So, depending on how you all do your banking system, that's a factor. But for me, everything I do is monthly. When I lend money out, I get a monthly check coming back. When I buy a vehicle with my policy, I make a monthly payment back. When I pay off a credit card with my policy, I get a monthly payment recycled and recaptured. So it doesn't matter that it's monthly for me, but I am paying an extra 75 basis points, because if I borrowed directly from my insurance policies, it'd probably be right around 5%. So this convenience comes at a cost of 0.75%. For me, my time is worth a hell of a lot more than 0.75%. So for me, I just value my time more than I value 75 basis points. But no, you do not need one.
What if you say, let's say you need like a year or two before you could start repaying your loan? In some cases, talk about not being an honest banker being discussed.
I've been there. So many years ago, I took a loan from my policies. We were doing this flip. I took a loan from my policies to do the renovations on that house. It was a nightmare of a property. We got popped for asbestos. We got hit by everything but the kitchen sink. And actually, I think somebody did get hit by the kitchen sink.
I think it was 55 Newman, like you said.
55 Newman Place. And the reason I give you that, folks, is some of you will go back and you'll Google 55 Newman Place, Buffalo, New York, and you'll see the house, which was beautiful when it was done, but during the process, it sucked. It took me years to finish that. Those loans I took from my policy, guess what I did not do for years? I never made a single loan repayment back to those policies. I never made a single payment. Why? Because I just simply didn't have the money. But when I sold Newman, okay, when that property sold, guess what I did? I got the closing proceeds, I deposited them in that company's bank account, and I wrote a check back to my policies to repay those loans. You're damn right I did, because I was an honest banker. And I repaid as much of the interest that I could, but it wasn't all the interest. So when you're your own bank, you're going to have your own challenges too. There's going to come times where you can't make the monthly payment. My suggestion is you find the closest mirror, you go into the mirror and you look in it and you just say, hey, Mr. Banker, got a problem. Lost my job. Things have been rough. I can't make payments. Is it okay if I take a couple months off? And the reflection in the mirror will look back at you and say, yeah, that's no problem, but don't steal from your bank. See, when you're your own bank, you set your own terms. If it means that you can't pay the loan back for 2 years, no problem, but don't steal from your bank. If in 2 years or whenever that time frame is that you get money like my scenario, I didn't forget my banking system. I paid it back, and I paid it back what interest I could. because I always pay my banking system back, principal and interest. Is it always what I promised or what I wrote on the note? In that case, it was not, but I did what I could.
I threw the Zillow in the chat. It looks super beautiful. Black ceilings, black floors.
Yeah, it was a really cool project.
At some point, as your payments reduce the loan interest, will the extra interest, your savings going back into your policy exceed the amount cap that your policy can hold?
I love that question. Absolutely, positively. So as I'm doing this and I'm repaying the policy, so just use this car example. Remember, $16,000 or $1,682 a month going back into my policy every single month. I only took a loan for $96,000. They only charged me 5.75, which means mathematically, I will not be able to put 5 years worth of payments back into my policy because it would mech the policy. I can pay back just the $96,000 plus the interest charged. Anything above that is going to have to stay in the segregated account. Hence why I have 9 policies. Now, I've been doing this for a long time. So folks, I just want you to understand that time is on my side here. For some of you, you're just getting started. It takes time to build this kind of a system up. But because I've been doing this for so long, I've had that scenario exactly happen many times. And just imagine if it was 12%. Now I got myself a big spread. When extra money's built up here, I pay attention to it. This is something that I'm hoping Tess is going to be able to help for me and for some of you as well. In the future, we're going to have additional services that somebody else is going to be able to come in and you can pay them to do all this for you, just painting the picture of the future. But here, when money's building up in my operating account that I can't put back into my policy, what does that mean? Well, that means my banking system has limitations. I can't put all my money through my banking system, which is a problem. So what do? I open another policy. Why is it that when you drive down the streets in your town, your city, or your village where you live, that there's never just one branch of the bank that you bank at? There's always multiple branches. Even the smallest community banks have multiple branches. Why? That branch exceeds its limitations and they open a second so they can expand the ability to take on more deposits. Mine is no different than theirs.
So maybe just clarify a little bit more what we were talking. We've shown a lot of examples like this, Chris, but I'll read through it. I get how this works for high interest rates above the policy rate, but please explain how does this work if the current bank interest rate is lower than the interest rate from the policy loan? Is the concept just to start recapturing your money even with the higher policy rate?
It's a really good question, Lance. It's just a math equation. So remember, in this scenario, when we take the loans from the policy, our money still continues to earn interest. That's got to be factored. So I'll give you an example. A couple of years ago, when interest rates were near zero, you could get a car loan for like 1%. Remember those days? They weren't going to last, but you do remember those. So we had a lot of people when we were teaching this say, well, I can get a car loan from GM or Ford at 1%. Why would I use the insurance company at 4%? Because back then loan interest rates were 4%. And a lot of times, if you ran the math, it did not make sense. So what we told people to do is we said, okay, just get the car loan at 1% and make monthly payments. But then what we did is, if we can just go one step further with this, let's just say that scenario happened where over on this side, the opportunity zone, it doesn't make sense for you to do a car. Okay, so what I would do is instead of the opportunity being a car, I would loan that money out. And we did this. So I might loan that money out to the Fullers or someone else on Private Money Club and make 12%. Then I take the 12% and I pay my car payment. See what I'm doing there? So I take the 12% that I make and I make some of the car payment. And then all I do is I always want to make sure that if they're charging me 5 cents, well, back then it would have been 4%. So back then the loan would have cost me 4%. So out of the 12, 4 of it gets sent back to my banking system. Why? Well, because that's what it's going to cost. So then in that scenario, all I'm making is the spread here. Okay. So I make the spread from the 4, at that time it was 6% with the company I was using in the 4. So I was making a 2% spread. This is just what I used to teach. And then over here, so now I got 4% less. So I'm at 8%. I take that 8% and I use that to pay down my car payment. Same thing. Your money's still working for you. It's just working for you in a different capacity.
And kind of right along with that, would it be best to take a loan from the policy to pay a credit card with 0% interest, or would it be best to wait until that interest is close to ending to pay off the balance?
First off, there's no credit cards with 0%. Now I know what you're saying to me. Yes, there is. I have one. Yeah, but for how long is it going to be 0%? Let's be real with ourselves sometimes. A 0% credit card, it's a cheat code for them. They get you in at 0%. And then once that 0% intro offer ends, usually 6 months, sometimes a year, what does your rate go to then? So don't look at the 0%, look at what your rate's going to bump to, and then look at the probability of you actually being able to pay that credit card off at 0%. Most people don't. And then the rate jumps to 29.99%. Now, does it make sense to pay off 29.99% with your policy? Yes.
All right.
So Jimmy said 0% cost, a 3% balance transfer fee. So yeah, there's no free lunch, folks. The government doesn't give you free money. Let's always remember that. The government doesn't give you free health care. The government doesn't give anything for you for free because there's always something attached to it. Credit cards are never giving you free money.
All right. So Philip said, can you explain the lack of MEC rules inside a family trust?
If it's a federal trust, okay, which is a trust that has an EIN number, usually irrevocable, and if it's set up properly, so notice I got to get some of the things. Now, I've come to the point now where I hate the word trust. I had some jackass on Instagram make a comment to one of my posts about Be Your Own Bank, because it's a free webinar, say, hey, come learn how to be your own bank next week with, the 2323 event. And he says, don't listen to this fool, open a trust and be your own bank. That's what he said. The problem with trust is people think that a trust is a magic thing. It is not. A trust can be one of the worst things you ever set up if you don't know what the trust is, what it's being set up to do, and what problem it solves for you. But let's get back to the question. So you used a family trust. It could be a business trust. Like, don't get caught up in the type of trust. Get caught up in, is it revocable or irrevocable? If it's an irrevocable trust, federal trust, not statutory, set up the proper way. If the policy is owned by the trust, and if the beneficiary is the trust, then chances are there is no MEC rules, because if the trust corpus owns the policy, then the MEC rules don't apply because there's no taxes on that. There's a little bit more to it. I'm not a CPA. I can't give you tax advice, and I'm not giving tax advice here. Consult with your CPA or tax advisor for that. Jimmy just happens to be one. But yes, inside of a properly structured trust, an irrevocable trust, if done right, there is no MEC. The MEC exists, but it doesn't matter if the policy MEC. So hypothetically, inside of the trust wrapper, I could take $100 grand, dump it into a single premium whole life policy, MEC the crap out of it, and as long as the trust owns it and the beneficiary is the trust, doesn't matter.
All right. Here's probably the question of the day. How do I get my wife to stop using the credit cards?
I haven't figured that one out. But can I go one step further on that one? Don't get your wife to stop using the credit card. Set limits to the credit card every month, and then teach your wife how every month you take the policy proceeds, you pay the credit card off, you make the credit card minimum payment back to your policies, and how cool that is. And then tell her, look, if you ever go over the limit I set for this credit card on a monthly basis, then we won't be able to pay it off. We won't be able to pay this money back to ourselves. And you see that difference right there? You have to pay that. So you're going to have to go get a job or work overtime. That might help. Yeah, there you go. Michelle just said, reduce the credit card limit. I forgot. You can do that. You can literally have a credit card, and have a preset limit that you put on it. All right. So I just want to pause for a second, and I want to just have Shauna talk a little bit more about the challenge, the reason that we set this whole thing up, because today's main topic was, take us from the basics to the second part of recycling and recapturing and the importance of that. And we did that in several capacities, and your questions just made this training so much better. So I had no problem spending all that time on that. But Shauna, do you want to take over from here and just talk a little bit about the challenge that's coming, why we're doing this, and how this is going to play out?
Yeah. So far, the first week of challenge has been to do a budget. If you had, you could either do something like mint.com or YNAB, which is youneedabudget.com. Those are free. We also sent out a spreadsheet. And then that was to really help you find your number that you could potentially start your own policy with, find how much. Oh, it's not free. I thought YNAB was free. It said it was free. So then that's like a number that you would be able to start your bank with. Cause I think last Wednesday, I forget, Chris called it disposable income with your budget. And then someone in the chat said, I call it my working capital. So when you find what's left over, put it to work. And then we read Richest Man in Babylon over the weekend. So if you read that or reread it, put like a 1 in the chat. I reread it on Saturday. It went like so much faster. Whoever suggested putting it at like 1.5 speed, it was like over and done with before I even knew it. Like Chris mentioned, it really hits on the saving 10%. And then it also, the last chapter, it really stuck out to me where I forget the character's name sometimes, but it was just like, if I was rich, I would, buy whatever I want, and I wouldn't work, and blah, 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 blah. And the one guy was like, well, that's like what the rich actually, once they realize that, they like want to work, and, work becomes their best friend. So you don't have to be an entrepreneur and own your own business to do infinite banking. You can have any job. And frankly, once you know how to handle your money, I feel like, you look forward to those paychecks and making those decisions. Earlier, Chris, when you kicked this off, it reminded me of, it was like a little post that Justin from Kearns Capital had shared, and it was like a quote from Elon Musk, and it said, it's easier to make $10,000 than it is to save $10,000. And once you learn that, like, your whole life will change. So again, you're not going to be able, so doing a budget and all that stuff is not to make you try to like strap yourself and save yourself to wealth, because that's not necessarily, at least I think that we can all agree that like, that's not really the best ways. You can't save your way to wealth. You have to put it to work and learn all those things. So definitely anybody who's new today, like, thank you for coming, and just continue to stay here with us. Coming up in the challenge, so the next week, we're going to try to, there's a video in the next couple of days where it's your policy video that you break down, Chris, where you have all the 4 designs and you talk about that. So it really just kind of recaps the infinite banking concept again. And it's a really good edited video. And then we start to, one of your challenges is to join a Money Club Monday and start to learn about using your infinite banking in private money club, and using it in real estate, or at least something like that. And I think that's really it. And another challenge might still be, joining the Facebook groups and being able to, say something that you learned or anything like that. But speaking of private money club, there was a member that I had interviewed once, Jerry Lipsy, and he has an infinite banking policy for himself, for his wife, for his kids, for his grandkids. And he said, it's not a get rich quick scheme. It's a get rich for sure. So I really loved that. I definitely wanted to give Jerry some props for saying it in that way. I like loved when it came out of his mouth about the infinite banking. I will, Christine, I'll put the link to Audible in the chat. And then there was also, you can find it on YouTube as well, a YouTube video, and just speed it up. But it was a really great book, and that's really it for me for wrapping up the challenge.
We have some overachievers on here. I know we do. So can I add 2 additional challenges?
Mhm.
So for anyone that's an overachiever, what I'd like to do is, and you can pick whatever day, that you want to do this, but I'd like for you to add one day Ray Dalio's video, How the Economic Machine Works. It's on YouTube. Okay. So How the Economic Machine Works. And then another day, I'd like you to watch his other video, The Changing World Order. And I want you to do them in that order. So How the Economic Machine Works one day, and then the second day, Changing World Order. When you watch those 2 videos, it'll really paint together, it'll really seam together and paint together where we currently are, so that you all understand that what we're teaching is not because we're driving an initiative, not because we're driving an agenda, but because we're literally trying to save you from falling off the cliff. I know it looks from the surface like when a lot of you are looking at the stock market, you're looking at, the S&P 500, and, you're seeing it go up, you think that it's all over. But I want you all to know it's a trap. It's called dumb money. And I don't mean to say that. I'm not alluding to any of you being dumb if you're thinking that you should be putting money in the S&P, or your advisor saying, oh, you should put your money in index funds. Promise, I don't want you to think that I'm calling you dumb, but it's literally in the industry called dumb money. Dumb money right now is piling into indexes. Dumb money is piling into the S&P 500. Dumb money is piling into the Dow Jones. Smart money is going the complete opposite direction. Smart money is buying treasury bonds while they're low because interest rates are high. Small stocks, startup stocks, the Russell small cap index, the Russell 2000. I'm not saying that that's a good place to put money. I'm just saying smart money, institutional money, is going the complete opposite place you're told to put your money, or that you're thinking you should put your money in. And again, this is just another one of those myths that I can't fully explain, but so many people face a very real, I call it a disease. It's called FOMO. It's really, they don't have like prescriptions or anything for it, but it's called FOMO, fear of missing out. because the markets are going up. You're hearing me say, get your money out of the market, but then you're hearing your advisor say, oh no, put your money in the market. And you're seeing everybody else put their money in the S&P, and you're torn. You don't know which way to go. All I want you to do is, when you got to ask that question, I want you to logically think, dumb money is going into those, smart money is going away from those. And that's not me saying that. And when you watch these two Ray Dalio videos, he's not going to call it dumb money or smart money, but you're going to see exactly where we're headed. The signs are all around you, folks. I always, I like classic rock, and there's that song, signs, signs everywhere, signs. Like, sometimes it pisses me off that people can't see the sign. It upsets me because they're very blatant right in front of your face. Like, I think every day when you're walking, you run into one of those. Anyone ever do that? You're not paying attention, you're on your phone, and you literally walk into a sign. I've done that. I want you to think about that, because that's what is out there right now. You're walking into the signs telling you, beware, beware, caution. Like, all those signs are right there. You should not be chasing returns right now. You should be preserving and protecting your money. It was the whole theme of our 3-day training that we just got done. Preserve and protect. This is not the time to really focus on growing your wealth. This is the time to make sure you don't give it back. And I can't preface that enough. People are like, oh, how come you're not just taking the $87,000 and putting it into the market or putting it into this investment? Because I'm smart, folks. Because I'm not dumb, and I'm not chasing dumb money. Because I realize right now that the smartest thing that I can do with my money is just hit base hits. That car is a base hit. The copy machine out there is a base hit. Funding marketing with my company, with my policy, a base hit. Folks, I'm not swinging Babe Ruth style. I'm not swinging for the fences. I'm not trying to hit home runs, and nor should you be. The most successful ball players are the ones that hit base hits. Yes, out of the ones that get all the notoriety are the Babe Ruths, but then just study the stats. How many times did the dude strike out? How many times can you strike out before you can no longer strike out again? Your money will run out if you swing for the fences. Your money, I hate to say that, will graduate before you do if you swing for the fences right now. There will be a time to swing for the fences, and I promise you, we will be the biggest cheerleaders when that time comes. We will be telling you, pull out the big bat, folks. It's time to swing for the fences. And it doesn't matter where you put your money, because all of them are probably going to go the same direction. Just one will get there quicker. But don't be dumb with your money. And don't follow the age-old institutional insider term of, look at all these dummies putting, chasing the dumb place to put their money. And that right now is the indexes, folks. It really is. And if you only knew what I know, even a fraction of what I know about what's about to happen, you probably never put your money in the stock market again. But some of you will. And some of you will have to learn the hard way, which is perfectly fine. But please, when you learn the hard way, learn from it.
I actually feel like everybody on here is not going to learn the hard way, because I was on Russell Brunson's webinar earlier today, like the ClickFunnels guy. He has a challenge going on right now, and I was watching his webinar, and they talk about how, like, when you cast your net, there's only so many people that end up making it, right? And like, when you know something, you want everybody to know it, and there's just some people who just it won't sync with. So everybody who's here, I want to give you guys props, because I don't think you guys are in the right place with the right things on your mind, that it's going to happen to the other people and not us.
You're right. Pick up the pieces. This is our clan. I mean, we had 100 and I don't know what the high number was today, but almost 200 people on here today, and I agree. Sometimes I'm just a perpetual like sounding board where I talk to everybody, like, don't do this. But it's because they know people, that they work with people, that are those folks that I'm talking about. Somebody just made a comment I wanted to just hit real quick, and it's kind of something we can do as a group, and then we'll hit all your Q&As in the Q&A.
I'll see you guys at 4:30, and then at 6 p.m. Eastern, we got the money tank. I don't know, Sean, if you have that link, but if you could post that one, I didn't have it.
Yeah, I will look for it right now before we get off.
6 p.m. Eastern, we're going to get into how to do private money loans, like what the kind of some of the paperwork looks like and the protections involved, and how to start evaluating deals. So we'll get into that at 6 p.m. Eastern. See you guys there.
So Michelle said, are you moving all your bank accounts to big JP Morgans where they want us all to go? The answer is right in what you said, where they want us all to go. Wherever they want us all to go, just know that I'm going the opposite direction. So what bank accounts I'm using, I have one commercial bank account from our corporate accounts. It's Key Bank. I don't like the bank, but it's just, we have to use a commercial for the online banking. But the majority of my banking is done with really small community banks. And I have several of them that I have small accounts with. I have a Cornerstone Credit Union, which I keep an account there, not with a lot, like just a couple grand in it. Community Bank is where I keep all my trust accounts. And I keep some of our business accounts there as well, but I don't keep, just so you know, like we really don't keep any significant amounts of money in the bank. Matter of fact, like some of our corporate accounts, we have more money in them right now than I want. And Shauna knows, like I'm always like sending messages to the bookkeeper. Hey, take this much and shift it over to Rob Fuller, take this much and get it over to here. And a lot of times, like nobody even knows what happened to my bank accounts, i.e. my wife. She's like, Chris, the other day we had more money in the account. Where did it go? I'm like, I don't know. Where did it go? I move it off to one of the other bank accounts just so that it's shuffled around. I play the shell game, folks, the cup game, and I just move money around to different accounts. So, you know, if you have any kind of significant money in any banks, and significant money to me is anything over 50 grand, don't keep it in one bank, shuffle it around. Oh, but Chris, they guarantee, you know, FDIC up to 250,000. Yeah, well, when there's a run on the bank, I don't care what the FDIC guarantees, they're probably going to shut the bank down and you're not going to be able to get your money. If we can't learn from the past, then we don't understand how to move forward in the future. And what you just saw with Silicon Valley and Signature and UBS and so many of the other ones, like, I don't care if like none of them lost any money. And we all know that because the Fed just printed money. Oh, but it's not going to cost taxpayers any money. Bullshit. Anyway, but the thing is if you needed money for an emergency, if you had an opportunity come to you and you needed the money out of your bank during those periods where they shut those banks down, tough luck. Play the shell game, folks. Shuffle your money around to multiple bank accounts, and there'll be a lot more on that. Yeah, Colleen, I have zero money in stocks. Zero, none, zippo. I don't want any money in stocks right now. I just think it's playing Russian roulette. I just got back from Bahamas and I watched all my colleagues, not going to name any names, go and gamble. And the common theme was, oh yeah, I got my ass handed to me. And everybody's like, oh, you know, you're going to play blackjack, you're going to play roulette. I'm like, I don't gamble. I don't gamble. And I don't. And I sat there behind some people on our team, and I said, you're done. I literally told somebody on our team, they were going, she was about to go into another hand, but the table had flipped. I said, you're done. Take your profits. But it's only $25. I said, yeah, but it could be all of it could be gone. Take your profits off the table. And she listened, but I don't gamble. Jimmy said, have a client who bought an SL 550, nice car, did it with an Amex card with a $350,000 limit. Not bad. A lot of points right there, man. See, I'm picking up what you're putting down. The vehicle cost $156,500. Client got the travel points off the card and then took a policy loan and paid the credit card purchases in full within the billing cycle, so no interest. Then simply put in place exactly what I outlined with the loan repayment. So one easy additional step, like that is brilliant. So if any of you have one of those credit cards and you're going to buy I mean, Shauna, we do this with Money School all the time. Like we put everything on an Amex card and we pay it off every single month in full. Why? Because I travel for well, I don't know. We use those points. What do you buy with them, Shauna? You buy everything. I mean, coffee.
Yeah, I end up.
Coffee was bought with points. What else?
Yeah, Amazon is like one of the simplest. It's like so easy for me to order stuff for the office. So a lot of like our camera equipment I buy with the points,
Yeah,
like
this camera was
granola
beautiful.
bars and coffee so that we have it at the office, toilet paper. You know what I mean? Like we don't have to spend our money on that stuff.
Yeah, but remember, like, you know, if you do that, you got to have systems in place. Like what Jimmy said, like that guy bought a $150,000 car, but see, he had the money in his bank, his policy before he bought the car, and then he just played the game. I mean, I can't even, that's a lot of freaking points. I mean,
Heck yeah.
he's going to Hawaii.
Well, because that's actually
First
something
class.
that's something that the even for the real estate people, right? So like that's something that I know you and Larissa did very heavily in flipping is you use the credit cards to buy all the counters from or all the cabinets from Lowe's, all the appliances, like all the lumber and all that stuff. And it adds up in points that you can benefit from later that really offset things. And then if you have the infinite banking policy, you know, right there, it's why wouldn't you use a credit card, right? Like benefits for sure.
Even for our trusts, we have an Amex card for each one of our trusts, including our foundation. So like when I was in New York City and we were there on a board meeting, well, Vivi's birthday party, but it was a board meeting for the foundation. And we made a donation to Howard Stern's wife's charity. We did that using the foundation's Amex card. Why? Same reason what Jimmy just said his buddy did for the SL 550, like same thing. Like, why wouldn't you get, you know, that if you play it right with credit cards? And see, the problem with that is a lot of people love that idea, but then they get a little loose and all of a sudden they don't pay the credit card off. That's what the credit card company wants you to do. They want you to lose the game by not paying the credit card off. They want you to trip up because then they hit you with the interest. But if you're good at it and you're conditioned with it and you always spend within the, your range that you can pay off every single month, like there's not much else better than that. And hell, if you got one of those black cards, or heck, even the silver platinum cards, you can get like a couple $100,000 on those. Buy your car with it. Shit, I don't know what I've got on mine. I should probably buy Larissa's with the Amex. We might have to look and see what our limit is on some of our credit cards. I don't even know these things anymore. Anyway, good suggestion there, Jimmy. I love it. Keith just said, you said if you only knew what's going to happen, you would never put your money in the stock market. So what's going to happen? The stock market's going to hit its third and final leg down probably before the end of the year. And then next year, we'll probably be at the low points and deep into a recession. I mean, we're not going to pop out of this thing, folks. And I know there's always hope, but we're not going to. The inverted yield curve, I'm going to reference just the one thing. There's plenty of signs, but I'm just going to talk about the sign that we've all walked into a couple times over the last year. It's called the inverted yield curve. It's where 2-year treasury bonds pay a higher yield than a 30 or a 10-year treasury bond. It's inverted. Should never happen. And it has happened lots of times in history. And every single time since World War II that has happened has resulted in a recession. So when you ask so what's going to happen? Well, a recession is going to happen. Some would say we're already in it, but because of unemployment numbers being so low, it doesn't feel like it. We're still out there spending money. Why? Because we still have jobs. But anybody that has studied recessions and understands recessions like me or Ray Dolly or even Jimmy or anyone, they know that when a recession hits, people lose their jobs. The economy softens and slows down, people lose their jobs. Look at commodity prices right now. You want to look at that? Look at logistics. Talk to truck drivers. Talk to train or railroaders. They're getting laid off. Okay. Just today, I can't remember what other company announced more layoffs, but we're not feeling it on Main Street yet because you're still employed. So where are we going? Well, we're going into a recession, man. And if you understand what a recession means, you will understand what the outcome will be and you'll understand how to plan for it. But if you wait for it, it's too late. If you wait for it, it's too late. There's just, as Brent Kessler would famously say, the juice simply isn't worth the squeeze. Right now, the returns you're going to get in the stock market simply isn't worth the squeeze. You got to know your risk and reward profiles. What risk are you willing to take for what reward? The juice, the reward isn't worth the squeeze, the risk. And Keith, if you're a professional trader or something like that, maybe you could make the argument against that. But outside of that, we could go toe to toe and I'll show you all the signs. I mean, my videos on YouTube show them all, and I've been doing it for years now. But I get a lot of hate and a lot of people that say, you've been saying that for years, and I have. Because the one thing that no one will ever be able to predict, nobody will ever get right, is timing. You cannot time the market. I can tell you exactly where we're going, but I can't tell you when we're going to get there. And I won't, because nobody can do it. Ray Dalio almost lost his entire company by thinking he could time the market, and he got it wrong. And he talks about it a lot in his book called Principles. And I'm sorry, if Ray had to learn that lesson the hard way, well, I don't want to learn the hard way. I'm just going to listen to how Ray learned it, and I'm just not going to make that mistake. So be realistic and don't get greedy. So last question I'm going to hit is Letta's question. How do I use the policy for real estate and the interest as a tax write-off? So it's quite simple. So I'm just going to make my screen big, and folks, will finish with this. We all know the challenge. Shauna will email you all of the challenges every single day. And then if you want to be an overachiever, you got those 2 additional challenges that I gave you. So here we go. You got your policy, and over here you got real estate. So a lot of people enter real estate because they want the tax write-offs, right? This is the big reason. You can get the deductions of you can depreciate it. I mean, there's lots of different things. So we'll just talk about depreciation. So if that's your goal, is the tax write-offs in real estate, here's how you could use the policy. You take the loan from the policy, you use it to buy real estate, okay? So the real estate will kick off some type of a return. Let's just call it rental income, okay, for the simple sake. So we'll just talk about rental income here. So it kicks off rental income. This loan that was sent over here, we got to add a step. So let me just add the step. We took the loan from the whole life. The whole life is owned by you personally. Now it could be owned by your company, but let's just assume you own it personally. And you loan the money to your entity. So in the middle right here, what we have to do is a promissory note from you, okay, to your entity that's going to buy the property. And then it has to spell out the terms of that note. let's just say it's 6%, $1,000 a month, whatever. I mean, the terms are whatever you make them, but you've got a note. Now, once this note is signed by the executor of your company, which is you, so you sign it, then the property is bought. Now the rental income or whatever this $1,000 is gets paid back over here, okay, to you, $1,000 a month. That $1,000 a month payment that was made, if this is just interest only, so I'm assuming interest only, no principal, okay, we're just doing a 6% simple interest deal. The $1,000 a month paid back to you is a tax write-off to your company because it's interest expense. So interest expense, okay, so your company gets to write this $1,000 payment back to you off. Now, if you're smart or you have a tax accountant, they're gonna be like, yeah, but that's stupid. Why would anyone do that? That's taxable money to you. Indeed it is. The $1,000 a month in interest that your company paid back to you is now taxed on a personal level. Now I'm gonna stop right there because I'm not a tax accountant, I'm not a CPA, and I can't give tax advice. If your CPA just ends right there, get a new CPA. That's the only thing I'm gonna say. See if Jimmy will talk to you. See if, Tess will talk to you. See if Zach Newberry or anybody on our team or Corporate Capital's CPAs will talk to you. Because if that's all they say is, yes, it's a tax write-off to you or to your company, but it's taxable to you. So why would you do that? Find a new CPA. Your CPA is absolutely correct in saying that. But this piece right here, tax to you, there's a lot that can be done there. Okay. And there's also a lot of other ways to do this, but I'm just trying to keep it nice and simple without going out into left field because I just can't give tax advice. Hopefully that helped. Where's Cash today? He's sleeping. He's right over here, sleeping on the chair. He's lazy, So with that being said, folks, I'm going to wrap. I know we went about 9 minutes over, but I wanted to make sure I got everybody's questions answered. Did everybody find this useful today? Still got 150 people 9 minutes after, so that's always a good thing. So here we go. We're going to just put some things in. Shauna, if you can just put one more time the training we have going on tonight. We're going to put that in the chat. And also for any of you that want to join us at 4:30 for Ask Me Anything, we're going to be answering more questions. So get your questions ready, grab a cocktail and meet us at 4:30 for the happy hour. And you can join us either through any of my social media platforms on Facebook or YouTube, which is the most common one. With that being said, thanks everybody. Appreciate you joining us for the second round of the challenge. And I hope all of you take this knowledge and you apply it in your life. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.